Hey traders, Stephen Quitzel here with thetradersplan.com, and today I'm going to cover a simple set of rules and teach you how to time the market. So stay tuned. Okay, so I'm going to really dive right into it. We're going to cover how to time the market. I'm going to show you some of the benefits of market timing and having a market timing plan. Today I'm going to cover a very specific set of enter and exit strategies for your stocks, and we're really going to use ETFs for this. And I like to use ETFs when it comes to market timing, and I'll share that with you here in a minute. But I think a specific set of rules, right? A trader's plan is very important because it allows you to look at the market objectively. A lot of times, the market's going up and we think it should go down. I'm sure you know what I'm talking about, or the other way around. So by having a specific set of rules, not letting our emotions get the best of us, it can keep us in a trade or it can allow us to exit a trade no matter what we think about the market. We're going to cover, never let a small loss turn into a big one. So you should never have a 3 to 10% loss turn into a 50% loss, right? We're going to cover where you should have that stop loss in place. I always say if you're going to lose quickly, right? Because not every trade works in your favor. So if you're going to lose, just lose quickly and get out. Don't let it turn into something catastrophic. Completely avoid the bear markets, and I think this is a huge one. When you have those 50% corrections, it takes 100% gain to break even on a 50% loss. So we want to completely avoid the bear markets. We don't want to buy and hold through them. We want to profit from them. So I'm going to show you some rules on how to do that today. So these are the historical rates of returns, right, for the strategy that I'm going to teach you today. Now this is starting January 1st, 2007 through May the 18th of 2016. So you can see right here, if you had invested $10,000 in the S&P, you would have immediately been playing from behind because you had a really, really big dip. Right? And then it starts coming back. So this is a buy and hold. You would ended up with $17,047.45. Now, I have a long only strategy and I have a long short strategy. So if you, and this is not buy and hold, this is my how to time the market strategies. So my long only time the market strategy, if you would have invested $10,000 on January 1st, 2007, you'd ended up with $24,040.72. There's a pretty big difference there, right? So again, you're not playing from behind. This is just a much smoother ride. And then if you want to add a little bit of juice, and if you like shorting the market, then you can, I'm going to teach you my short strategies today. And you can see right here that it did a lot better, $52,431.72. Now, I've been developing this system since 2012. I've been trading it and perfecting it really since 2014. So this is a back-tested system, or at least it is back to the January 1st, 2007. Again, I've been trading it and perfecting it for a couple of years, but these are back-tested results. So just full disclosure there. Now, why time the market? This is a 26-year chart, and I think this says it all. So if you really have these major bull markets, right? And all of a sudden that long-term trend, that bull market gets broken, you can see, boom, you had a 50% drop. Your portfolio was cut in half if you were a buy and hold investor. You got another bull market, right? All the way up to 2008, boom, your portfolio was cut in half, right? If you're a buy and hold investor, you know what I'm talking about. And it took all the way from, peaked in 2007. It took all the way from March 2013 to break through this. So that's a long time to just slowly grind and watch your portfolio just get back to break even. Now we have another long-term trend, bull market, and it got broken. The long-term trend is broken. Now, am I going to call for a 50% correction? No, I'm not predicting that, but I think it's important to look at historical precedents just to see what could possibly happen. But not only do we want to time the market to avoid these nasty situations, but we want to time the market because you're going to have long periods where the market is flat for anywhere from 12 to 18 years. And this has happened 4 to 5 times, since 1900, where you have these just really, really long periods of absolutely zero returns frustrations, even worse, you give up on the market. But when you have 20, 30, 40 years of accumulation before you retire, or even after you retire, right? And then all of a sudden you're buying and holding and you have a 15-year period where your portfolio does nothing. How frustrating is that? I mean, that can really, really wear your patience. It can cause you to make bad decisions. So that's why we really don't want to sit through this massive trading range of 13 years or anywhere from 12 to 18 years, right? We don't want to sit through these 50% corrections where it takes 100% gain just to break even. We want to profit from them. So I'm going to cover some ways to really help you today. So now, who can really benefit from this? If you struggle to consistently outperform the market, or if you own a handful of stocks and your account's really not going anywhere, if you don't have a solid written set of rules, right, that written trader's plan to really keep you looking at the market objectively, right, to keep your feelings from really overtaking your trading. If you don't want to buy and hold through the next bear market, if you're really looking for a strategy for consistent retirement income, stay tuned. Now, I've shared with you, this strategy is a long-term strategy. It is not for day traders. If you're looking to make a trade every week, we make a trade every month, about one trade a month. It's really, really simple. So if you're really looking for a little bit more active strategy, I wish you the best of luck. This isn't for you. But if you're looking for a simple and easy way to time the market and outperform the market over a consistent period of time, stay tuned. Quick disclaimer, got to keep the lawyers happy, so I'll let you read that. Okay. So we're going to cover 7 rules for how to time the market, okay? So 7 rules, 2 buy rules, 1 sell rule, and 4 short rules. So this 1 sell rule just means we're going to get out of our long and we're going to move to cash. And then the 4 short rules means we're going to get out of our longs and we're going to move short, okay? So these are 7 rules for how to time the market. This will be the only slide about me, I promise, but I wanted to kind of give you a quick background about myself. I got a background in economics and finance. I worked for a very large broker-dealer for about 6 years. I worked in a pretty good-sized practice with 60 million assets under management. I have a successful high-ticket sales company that generates 7 figures in sales for my clients. I live in the small working-class town of Russellville, Arkansas with my wife, Stephanie, and my 2 kids, Madeline and Graham. Okay, so why use ETFs? Well, I was really sitting there in my office in 2012 when I really had my aha moment, because I was sitting there doing just tons of research on stocks, thinking if I just had all the research that I would really, just continue to beat the socks off all the successful money managers. And I was thinking, instead of really learning about the earnings and the sales and the sector and the bankruptcy potential, just all the research and the high trading fees that we'll take with trading stocks, like what if I really just learned one thing and got really, really good at it? And that one thing to me was market direction. So I figured if I really could get good at timing the market and learning which way the market is headed, I could still make a lot of money with much less effort. So even with stocks, you still have to know the market direction because 75% of all stocks are going to follow the market. So with ETFs, you really are timing the market with ETFs. You really just got to learn a little bit of technical analysis and figure out which way the market is direction. I'm going to give you the rules to those today. So what is an ETF? If you are not familiar with an ETF, I'm going to give you the quick rundown real quick. Is an ETF, an exchange traded fund, is a marketable security that tracks an index, commodity, bonds, basket of stocks, just like an index fund. I used to tell my clients an ETF is a mutual fund that trades like a stock, okay? Now, a leverage ETF is an ETF that uses financial derivatives and debt to amplify the returns of an underlying index. So leverage ETFs are available for most S&P 500, NASDAQ. They aim to keep a constant amount of leverage during the investment time frame, such as 2-to-1 or 3-to-1. So for example, if the S&P 500 is up 1%, the leverage ETF might be up 3%. And same thing as, the other way around. There is no free lunch, I'm sorry. But if the S&P is down 1%, the leverage ETF might be down 3%. So now here are some of the lists of the ETFs I trade, and I trade for this system. I like to use the QQQ, right? The NASDAQ 100. If you trade ETFs, you probably know what that is. The power shares, the NASDAQ 100 is really just the largest 100 stocks in the NASDAQ. It's the index. Now, I like ETFs and investments with high liquidity. So this ETF has 35 billion in assets. That makes me really comfortable, right? Because I want to get in and out of something. I don't want to be whipsawed. There's no way I'm getting whipsawed with 35 billion in assets. I don't I don't have near that much. So now on the short side, I like to trade the SQQQ. Now this is where I will use some leverage, and I'll explain to you a little bit when we go through the rules why I like to use leverage on the short side. Now this is the 3 times the NASDAQ, the bear version, right? So that means if the NASDAQ is down 1%, this might be down 3%, or that's what it aims to do, and the other way around. If the NASDAQ is up 1%, this thing might be down 3%. So you really want to make sure it's got that inverse, you know, and same thing with the 3 times the S&P 500 bear, the SPXS. So if the S&P 500 is down 1%, this might be up 3%, and if the S&P 500 is up 1%, this might be down 3%, right? So you're playing the inverse. Both these ETFs have a little bit more than 400 million in assets. Again, a very liquid ETF, something I'm very, very comfortable with. Now, oh, by the way, if you don't have a pen and a piece of paper, you really need to go ahead and get that out now, because we're about to get started. I'm about to really cover the rules. I'm really excited to share this with you, but I want to make sure you write them down because you'll need a pen and a piece of paper. So if you're curious what in the world is in the NASDAQ 100, these are the top 10 holdings, right? The NASDAQ 100 top holdings, right? You got Apple, Microsoft, Amazon, Facebook, Google, Comcast, Intel, Cisco, Amgen. These are large American iconic names. I'm very comfortable a majority of the investments I trade just on these 10 names. So half of the weighting in the NASDAQ 100 comes from just these 10 names. So these are companies you have in your cupboard or you use every day. So this really makes me very comfortable that knowing that pretty much half of everything I'm trading is just these 10 names right here. Okay, so I want to give you a breakdown of the historical performance of this strategy. So you have the S&P 500, right, as average. Now this is year by year, okay? So you have the S&P 500 average 8%, 8.06, and this is excluding 2016 because we haven't completed the year yet. Now our long only strategy is up almost 4% for the year, while the S&P 500 is flat, so we're beating the market by 4%. The average on the long only is 9%. And you might say, well, Steven, you know, 9%, I mean, it's good, but it doesn't really crush the S&P 500. I'll say, no, you're right. But the reason that we consistently beat the S&P 500 when you're compounding those returns is because we're not playing from behind, right? And I'll show you that on the chart here in a second. So even though it averages 1% better, it actually does a lot better on the compounding interest because you don't have those big bear markets that you're going to sit through. So you can see the long short strategy. You can see it actually had some very, very good years. It was down 2011 and it was down 2015. But you can see for the most part, you have 2 years of losses. You have some really big years. It's done really, really well. You can see that the average is 21.5% over a 9-year period. Now, these are the amount of trades that were taken in each year. So each year, there's about 12 trades a year or 1 trade a month for the long short strategy. Okay, so 1 trade a month, and if you're looking for the long only strategy, you're probably looking for about a trade every other month. So it's really, really simple. The win ratio is about a little bit more than 60%, and the loss ratio is a little bit under 40%. You might also say, well, Steven, 60%, that's good. That's not like 90%. And I'll say, no, it's not. But when you take your losses really, really quickly, where our average loss is really about 1.75% on the long side, excuse me, you can still do pretty well because you're cutting your losers really short and you're letting your winners ride. So again, this is it. You have 8, 9, and an average of 21.5%, an average of about 1 trade per month. So if you could get these kind of returns and you're only making one trade a month, would you do it? Absolutely, I would and I do. So I want to kind of go back to this chart real quick just to show you, even though the long only averages 9% and the S&P 500 averages 8%, the returns on your portfolio are much better because you're not sitting through these big markets. You're not having to play from behind. You're not having to get a double just to break even, so you still end up very, very well. Okay, so these are the 3 things you're going to need to time the market with this system. All right, you need a chart of the NASDAQ. We're going to use a 20-day moving average, and you're going to need some kind of volume bars on the bottom of your chart, right? Something to be able to tell if there's, above average volume, below average volume. But these are the 3 things you need. Okay. Now, if you're ready, I'm about to dive right into the rules to share with you the simple rules on how to time the market. So I'm going to read these rules to you, and then I'm going to show you some examples, and you can write them down, but you can also pause this video or go back and rewatch them if you want to continue to write the rules down or make sure you get everything. So you can pause this right here if you want. So buy rule number 1, right? Purchase half a position in the QQQ the morning after the market breaks out. So I'm going to repeat, purchase half a position in the long QQQ the morning after the market breaks out. Right? And a breakout must be a minimum of 4th day off the recent low. NASDAQ must be up a minimum of 1%. Ideally, you want 2 to 3 in volume above the prior day. So really, you need an accumulation day, a minimum of a 4th day off the low with volume that's larger than the previous day. All right, so we start with a half a position, and then we purchase the remaining half position 4 days after we purchase the first. Must purchase higher than the first. That means we're averaging up, right? Never average down, always average up. So you want a 3.5% stop loss below the purchase price of your first position. So, because you might ask, like, why do I do that? Well, why do I break it up? Why don't I just go fully invested? Well, not all breakouts work. And what I have found, why I have this fail-safe in place, is most of the breakouts, when they fail within the first couple days. So if they fail within the first couple days and I'm only half invested, that means my 3.5% is really only a loss of 1.75% because I only have a half a position. Does that make sense? So let's look at some examples. So right here, this was 2007. This was pretty close right before the market topped, actually, right? You have, right, a recent low. You got a candle right here. Boom. Day number 1, 2, 3, 4. The market broke out on day number 5. Volume was higher than the previous day. And then you buy 4 days later. So I'm going to buy the next morning, right? The market broke out here. I'm going to buy the next morning. And then I'm going to start counting. 1, 2, 3, 4. Now you can see right here, this candle is lower than your purchase price. So I'm going to wait until it breaks through. Because again, I don't want to average down, right? I'm not trying to average down. I'm trying to average up. I want to make sure that the trade is working before I put more money into it. So it's still lower, and then boom, it breaks out. I can buy the remaining half right there, okay? So then you averaged in. Your average price is somewhere in the middle. And then you really just wait until it just continues, until we hit a sell signal, right? So you continue to wait. You can see it finds support on this 20-day moving average until it hits a sell signal, right? And then all of a sudden, we get the sell signal, this candle. This is actually a short signal, and I'll talk about it in a minute. But we got out right here the very next day. So you always want to sell the morning after the signal, okay? And what I found is, if you want, you can sell the day of, but sometimes the signal in the last 15 or 30 minutes, it doesn't hold. So you might have gotten out when you shouldn't have. So I like to make sure the volume and the price confirms the move through the close, and then I just get out or get in the very next day. So in this situation, you average up, you get a sell signal, a short signal, you sell all, you go short right here. You had a 10.6% gain in 50 calendar days. That's on the long side. Let's look at another example. Okay, so this is actually the market bottom in 2009. You'd have been really close to the market bottom. So March 9th, 2009, S&P 500 was 666. All right, and then boom, 1, 2, 3, 4, the market breaks out, right? So you're gonna buy half a position right here, right? And then start counting, 1, 2, 3, 4. You buy the remaining half right here. So the market broke out right here on it was more than 1% on volume above the prior day, so it was an accumulation day. And then you average in, your average price is somewhere in the middle, and then you wait for a sell signal. So then we sold all right here for a 10% gain in 39 calendar days. I'll explain again some of these signals here in a minute, but I want you to get the buy rules down first. So you have to, the market has to break out in above, it doesn't have to be above average volume, it just has to be an accumulation day above the prior day, a minimum of 1%. And then you average in. And again, we average in to make sure that if the market breaks out and then it rolls over, we're only half invested, okay? Buy rule number 2. If the system is in cash and then the market breaks a new high, now we're trading on the NASDAQ. Let me go back and be crystal clear. We're purchasing the QQQ, but we're trading on the NASDAQ chart, okay? And the reason why that is because the QQQ is only, that indice only has 100 stocks. The NASDAQ has thousands of stocks. So the NASDAQ is a better representation of the overall market. So we're going to trade based on signals of the NASDAQ, but we're going to purchase the QQQ. So back to buy rule number 2. So purchase half a position of QQQ the morning after the NASDAQ closes at an all-time high. So if the market, if we're in cash, we get triggered out and then the market turns around and breaks out to all-time new highs, you can't fight with the trend, you just go invested. So the next morning, right, you purchase half a position, right? So purchase half position the morning after the NASDAQ closes at a new high, and then purchase remaining half 4 days later. Same rule. So we're averaging in that way in case something turns against us, we're only half invested. Stop loss is 3.5% below the purchase price of the first shares, okay? So let's look at some examples. So here's an example, and this is 2007. This is the summer of 2007. So you can see right here, here's kind of a really interesting example because the market doesn't always, do textbook what we want it to do. But you can see we had a sell signal, we're out here, and then the market turned around, and it broke out to new highs, but it was also a breakout day, right? The market broke out, and it broke out to new highs. So that's a buy signal. So we invested the very next day. We put in our 3.5% stop loss, right? But that stop loss never got triggered, right? So it kept us in, right? It kind of pulled back. It found support at the 50-day moving average, right? It bounced, and then when it started to make new highs, right, we purchased the second half. Because again, that second half has to be higher than the first. And then we ride a nice little trend. We got out right here. We exited along and we entered our short. So you had a nice little 4.4% gain in 35 calendar days. So this is a rule, right? Breaks out to new high, same rules. You enter the very next morning, and then you count 4 days, but your second purchase must be higher than the first. Okay, so sell rule number 1. Now this sell rule is actually really simple, okay? So I use the 20-day EMA for the end of the trend, okay? So when the NASDAQ closes below the 20-day exponential moving average, right, we're out. So if we have a nice uptrend right here, this is 2013, you can see we got a nice uptrend, starts to get choppy, and then boom, cracks, we're out the very next day, okay? So this is where we would just, by the way, we don't average out, we just sell our whole position. So when you're long and then the NASDAQ closes, it has to close below the 20-day moving average, you're out the next morning. No questions asked. The short to intermediate trend is over. And it's really just that simple, right? Once you're fully invested, you use the 20-day EMA as a stop. Okay, so we're going to start to get into the short rules, okay? So here is sell and short rule number 1, right? Now, when we hit a short rule, if we're long, we're going to hit a short rule, and we're going to exit our long the next day, and at the same time, we're going to go short. So, short rule number one, and this is a pretty common short rule. If the NASDAQ gaps down 2% in above average volume, it has to be above average volume. And the market has to be above the 20-day, right? All of these short rules, we're trying to short on the back end of an uptrend, and it has to be above the 20-day EMA and then gaps below it, right? So at that point in time, if we get a 2% down bar in above average volume, we're going to exit our long and we're going to go short. So the very next day, we're going to exit our long at the morning and we're going to go short. So you can see right here, we exit our long, go short, and it didn't really, you can say it didn't break to new highs, it didn't stop us out, and then boom, right there. Excuse me. So the rules of the short are a little bit different. One, we're using leverage, and here's why I'm using leverage. You don't have to, but here's why I use leverage. All of the intermediate to short-term corrections that were in the market that I tested, most of them were really only like in that 5 to 7% range. If you would have just, which is why we're going to be proactive and take our profits at 6% on the short side. And I say that because if you would have, so really, if we're taking our profits, right, on 6%, we're going to use a leverage ETF, SQQQ. So really, the NASDAQ only has to be down 2% for us to hit our 6% target. Now, the reason I do that is if you would have got a signal and you enter your short and you're waiting for a bear market, you'd have lost money on almost every trade. Because most corrections are just minor, right? They're just like 5 to 7%. So you have to be proactive, and I've tested this. You have to be proactive and take your profits quickly, right? We're just trying to clip our coupons. You got to take them quickly. So the NASDAQ is down 2% in above average volume. We're going to sell the QQQ, and we're going to enter SQQQ, okay? Right here, right? And so you're gonna take a profit target. You're gonna have a profit target of 6%, right? And on this rule, your stop loss is gonna be about 0.25% above the high of the gap down day, right? So your stop loss would be up here, but it never even comes close to that, right? It just comes down, finds resistance, and then boom, you collect your 6%. So the interesting thing about this trend is you collect some money on the upside, you collect some money on the downside, and then boom, the market turns around and breaks out and you're back in on the long side, right? Long, short, long. So I'm going to repeat. If the NASDAQ is down 2% above average volume, you're going to sell your long and you're going to enter short with a price target of 6%. Only 6%. If you hold out for more, there are some times you'll be able to get it, but over time, you're going to lose on more trades than you'll win. Sell and short rule number 2. Okay, so you have a nice uptrend. This is 2013. And all of a sudden, if you get a reversing candle, right, that pokes to new highs and then reverses lower, and for the day, the NASDAQ finishes down 1% or greater in above average volume, you're going to exit your long and you're going to go short, right? Again, the stop on this rule is going to be 0.25% above the high. So if the market breaks out to new highs, you're out. But you can see you sold your long right here, you entered short, it tried to bounce. As the market typically does, if it gets oversold real quick, it'll try to bounce. But a lot of times when you get these nasty down days, the market isn't done, right? It wants to bounce around one chop and then it'll eventually roll over. So you'd have had a 6% gain in 9 calendar days if you just would have held it for a few days and placed your stop in. So again, if the market has a reversing candle of if it tries to poke to new highs and then reverses down and is down greater than 1% and above average volume, you exit your long and you go short with a 6% price target. That's it. Stop is just above the high of this reversing day, okay? Shorts are harder to play because it is more of a whipsaw type of market. and it's a more volatile market. So you can see this uptrend is a nice smooth uptrend, and then boom, something crazy happens, right? All of a sudden the market changes character, and then it starts to chop around a little bit, right? So we're going to get in and we're going to get out quickly. These short trades are typically much quicker than the long trades. Okay, so sell and short rule number 3. All right. So if you have 3 distribution days of negative 0.45% and above average volume, all of these have to happen above the 20-day moving average within a 2 to 3 week cluster, right? You exit your long and go short. So look, right, we have an uptrend, right? It looks like the market breaks out, right? You're uptrending, then all of a sudden distribution day in above average volume, and it all happens above the 20-day. Boom, the next day we're out of our long, and we actually would have got a better price the next day. We're out of our long, we entered our short. Now on this rule, you're gonna have a 6% stop loss. 6% stop loss and 6% price target. You might say, Stephen, well, that's not a great risk reward. Well, this, out of all the strategies I tested, this has a high win percentage ratio. So you can allow that, because a lot of times this strategy a little bit gets a little choppy, so you want to give it a little bit of room. Now, if you want to use the top, that's fine, but sometimes I've just tested and learned that with this rule, it's better just to use a 6% stop loss and a 6% price target. So right here, you had entered your long, right? It tried to poke to new highs, but then you just got rolled over. You'd collected your 6% gain right here. But then look, the market breaks out again. Now this is a failed breakout, because the very next day, boom, you got this down bar and 2% and above average volume. So the very next day we exit our long, right? And we're only half invested. Remember, we're only half invested right here. We're gonna exit our long for a loss of 1.75%. We're gonna go short, collect our next 6%. So you collected 6% right here. You collected 6% right here. You lost 1.75% here, but you collected a couple 6% gains, looks like in a couple weeks. So you'd have done pretty well. A lot of times when you have choppy markets or when you have bear markets, you are given multiple opportunities to short the market. So I'm going to repeat, 3 distribution days of negative 0.45 and above average volume. You're going to exit your long and you're going to go short. Okay, now I'm going to show you the 4th short rule, okay? So this short rule, a lot of times one reason why I use the 20-day EMA is because it really is widely used by a lot of traders as support and resistance. So what you have support right here on this nice uptrend, right? It kind of looks like a little mini head and shoulders pattern. But then you have a downtrend, right? And this is December of 2012. So you have a downtrend, and what happens when the market starts to roll over, a lot of times it'll try to retake that 20 and it'll just get rejected. So you can see it tried to retake the 20 and it got rejected. So when it gets rejected, you're gonna enter a short, right? When the 20-day EMA is down at about a 45-degree angle and it tries to retake it and rejects it, enter short. So you collected 6% right there. Boom, but it comes back, it tries it again. A lot of times it'll try it 2 times. Boom, it hits it, it gets pushed back down, you enter your short, you collect your next 6%. So you'd have had back-to-back 6% gains on your leveraged ETF, SQQQ. And again, if you don't like leveraged ETFs, you can use non-leveraged short ETFs. But just keep in mind that if you're really looking for more than a 2 to 3% gain on those non-leveraged ETFs, a lot of times you're probably going to get stopped out. So just keep that in mind. So you had a nice uptrend right here. You collect, 12%, 6% shorts right here, and then boom. I don't know what happens right here because the chart's cut off, but looks like you have a market breakout and it starts to chop sideways. So we'll definitely see. But that's it, guys. That is the 4th rule, the 4th short rule in this trading system, right? So I'm going to recap all of these just real quick, right? So you have buy rule number 1. You buy as the market breaks out, right? In above average volume, 4th day off the low, and then you average up 4 days later, right? Buy rule number 2, if the market breaks a new high and you're in cash, you buy the next day and then you average up 4 days later. Okay? Sell rule, if you're fully invested, means you've bought both half positions and then the NASDAQ breaks the 20-day EMA, you're out. Right? It doesn't mean we're shorting, it just means we're out. The trend is over. Okay? So we only short when there's a short signal. So a sell and a short signal is if the NASDAQ is trending up and then all of a sudden you get a 2% down day and above average volume, the next morning we're going to exit our long, we're going to enter our short. Sell and short rule number 2, you got a nice uptrend and then boom, you got a reversal of 1% or greater and above average volume, exit our long, enter our short. And again, you can pause this video, you can watch it over and over again. Sell and short rule number 3, if you get 3 distribution days of negative 0.45% and above average volume, all have to be above the 20-day, boom, you exit your long and you go short. Sell and short rule number 4, if you're in a downtrend and the NASDAQ rejects the 20-day moving average, right? It tries to break through and just gets slammed down, you enter short. A lot of times on downtrends, you can enter short twice. So I want to explain why 2015 was different, right? So 2015 was a very difficult year, right? The system, the long-only system was down, I think, 1%. The long-short system was down 6%. But, you know, sometimes it's really, really important to really understand why this was a down year and why 2015 was different, right? So I want to kind of walk through this for a second just to show you, you know, what I did, right? Because sometimes you really have to trade the market you're in, not the market you want. And the market I want is always an uptrending market or a downtrending market, right? But sometimes you have these sideways choppy action. And it tends to chop you up and spit you out. And if you were trading in 2015, you really know exactly what I'm talking about. So what happened in 2015 a lot of times is, you know, the market broke to new high, we have a rule to get in, and then the market would roll over. The market would break to new high, and then it would roll over. So we got stopped out a couple times back to back. Well, I started seeing a couple of divergences in the market. Divergence number 1 is the NASDAQ was poking to new highs, but the S&P 500 was not. Divergence number 2 was really all the breadth indicators, right? The advanced decline line, the New York Stock Exchange, the breadth indicator was looking like it was topping, it was rolling over, meaning fewer and fewer stocks are pushing up the market. So I felt that this was a long-term topping phase. So the next time the market poked a new high, I just started shorting, right? So I did override my rules, but again, sometimes you do have to adapt, right? You have to trade the market you're in, not the market you want. You have to be willing to adapt at times. So a lot of times when your rules don't work back to back, you need to take a step back and look, okay, what can I do to make some money? So I shorted right here, I made some money. I shorted right here, I made some money. I shorted right here, I made some money. I actually made a lot of money on the flash crash because there are really, when you have, you know, I woke up, the NASDAQ was down 8%. I didn't really, you know why or what was going on, but I knew that there were going to be trends in that day. So I bought at the very beginning of the day and I sold about midday when the market gained about 5%. So towards this middle half of the year, you can see, now here's the trades. I literally took them directly from my Charles Schwab account just to show you. Here's some trades I made really from June to, in a very, very difficult time of the year, from June to, October and September. But you can see, you know, I had some losses, but 6%, 6.5%, 5%, 14%, 7%, 7%. So you can see I made a lot of that, and those were on the flash crash days. But you can see, you know, sometimes when you are just able to adapt in the market, when I started shorting the market, I actually did pretty well. And I didn't get greedy. I just collected my gains, but I collected a lot of them. So sometimes you have to be willing to adapt. You have to be willing to make those changes when you're seeing a different kind of market. So there are different ways you can really utilize these signals for how to time the market. However you want to do it, you can use the signals for how to time the market with the ETFs as presented, and that's what I do, right? I use the signals as I present them to you. You can use them to buy and short stocks. If you like to trade stocks, you can use it when to get in, when to get out of the market. Now, you can use leverage ETFs or futures to trade on the long side. I would just be really cautious because leverage ETFs rebalance, and you definitely don't want to hold them for a long period of time. And if you don't really understand that, you need to do a lot of research on leverage ETFs before you consider going on the long side. Really just understanding what they are. Or, I have a client that actually does really, really well with this system. He writes and purchases options on the ETFs. He writes and purchases options on the trade signals, on these how to time the market trading cycles. So really, there are a lot of different ways you can use these signals. Now, if all these signals did for you, how to time the market would give you one strategy that would keep you holding through the next 60% correction, would that be worth it to you? Or if it would just give you one strategy that can allow you to pull an extra $1,000 a month in retirement income. Or if all this strategy did for you was allow you to retire 5 to 10 years early, would that be worth it for you? Can you do this? I know you can do this, okay? I know you can do this. You have the rules. It's just being disciplined and sticking to them, right? So again, you can go back, you can watch these signals. These signals are for you guys. Now, if you don't want to do this and you want a little help, you can go check out me at thetradersplan.com. You can look at what it would look like to become a member. I would love to help you in any way that I can. Whether you need my help or not, go check out thetradersplan.com. If you want to stick around and see some of my top rules for enter and exit strategies with stocks and ETFs, stay tuned. Hey traders, this is Steven Kowitzel with thetradersplan.com. I hope you enjoyed my most recent video lesson. There's going to be many more to come. I talk to traders all the time and they keep asking me the same thing. They say, Steven, I really need help timing when to get in a stock and when to get out of stock because I believe I'm losing money when I shouldn't be. So I designed and created the Savvy Trader course to really help you pinpoint with accuracy what is the best time to get in and out of a stock or an ETF that gives you the highest probability of success. And as a bonus video, I want to show you one quick trick. It's really, really easy to show you how to pick the exact bottom in a stock or an ETF. So click the button below or to the left or to the right of this video. I don't know where it's at. Just click it and get your free copy of the Savvy Trader course. I'll see you on the inside.